Hello ladies and gentlemen, and welcome to Common Basic Things. My name is Cruz, and today what I'm going to be showing you guys is how to make some money. Let's get it, baby. No, but seriously, I am just going to be showing you an update of my account. Like I said, I'm trying to be as transparent as possible, just trying to show you guys how I've been doing. I haven't been doing too great. I've been doing a lot better than I was these past couple weeks, around 4 to be exact, maybe 3, but I have been doing a lot better. Now, before I do start, keep in mind I'm not a financial advisor nor a licensed professional. If you'd like to invest in the stock market, please consult with a professional first. These videos are strictly for entertainment purposes only. Please do not try to. If you'd like to invest in the stock market, you're going to risk. Secondly, please slash that like button and subscribe. Sometimes it takes me hours to make these videos, guys, and I'm telling you hours. I am right here at 1:37, and I'm trying to make this video, but hey, it's gonna be a one take, right? All right. So, secondly, please smash that like button, subscribe. I already said that. All right, so let's get right into it, guys. All right, so how have I been doing? How have I been doing? How have my trades been doing? Well, not too great, as you can see right here, but I've been capitalizing on a lot of things that beginners do, and that's spreads. Spreads, guys, spreads. Now, in order to do this, you have to have a level 3 account. Okay, so you can go to your account, check it, see what level you are. If you are level 3, you're gonna be able to do it. And what does that do for you? Okay, well, for example, I've got a couple spreads right now, and I can show them to you. It's fine with me, but I can show you how you can capitalize on this. SPY, for example, this one's not doing too well right now. So you can see at 3, it closed at what, 17, okay? And let's go to SPY right now. At 3:17, at 3 p.m., it was at 367. It's $2 negative. It's red after hours by $2. That option is not going to be up 60. The good thing though, it expires tomorrow. So less time, the less amount it is. So I might be able to get out of it by buying it back. So it's a little bit complicated, but let me show you the easiest way to show you guys an example, okay? So let's go to Microsoft, all right? And like I said, you have to have options trading enabled to level 3 to be able to do this, okay? But once you have it, all right, boom, you're in. All right, so I don't know if you're familiar with buying calls and puts, but I can break it down real quick for you, really simple. All right, so when you buy a call, you're basically buying a coupon per se. So you're buying a coupon, right? Well, this coupon, for example, is going to cost me $415, okay? So if I buy this coupon, that's how much it's costing me, and it expires on the 24th. So this coupon, what does it do for me? Well, it gives me the right but not the obligation to buy this stock, Microsoft, to be exact, at a strike price of $220. But the $415, that's what I'm paying for that coupon. So that you can add it towards what you'd be paying for the strike price. So in totality, anyways, $224.15. Boom. That's how much my break even is. That's how much the stock has to go at if I want to at least break even. So it's only 2 days. This is not a good trade, all right? But what are you going to be doing when you're doing a spread? Well, you capitalize because you don't care about the time. Because all these contracts, they have a lot of things you have to take a look at. Delta, gamma, theta, vega, rho. There's a lot of things. They all have implied volatility. There's different things you have to take a look at. You can look at the open interest, see how many people have it in their accounts, of course. But how do you capitalize with this? Okay, guys? How do you? You may ask yourself. All right, let's go to next week, the 31st. Or maybe that's 2 weeks. I don't know. Anyways, let's go to 2 weeks, next week, and then some days. Anyways, all right, boom, you're here. So, how do you make money? You might be thinking to yourself, Cruz, what are you showing me? You're just wasting my time. Well, time no waste no more. So let's say you sell a call, right? Okay, so you bought this coupon, and you're willing to pay $230 on the 31st, which is when it's expiring, and you're paying $88 for this coupon. Now, I don't know, like I said, I don't know if you guys knew, but a contract is 100 times the strike price, the premium price, whatever, okay? Because a contract is 100 times whatever. All right, just keep that in mind. So if I buy this contract, this is a coupon, I'm paying 88 cents times 100, it's $88. So, boom. All right. Oh my gosh, guys, I was on selling. Oops, my bad. If you're buying that's the coupon, okay? If you buy That's what a coupon is. All right, when you sell, that means you have it. So no coupon. Okay. Anyways, oops. All right. Let's say you want to capitalize in spreads and you have the level 3 account, right? You have some money. You want to just try and risk it, no biscuit. Okay. That's what I tell myself sometimes, which I shouldn't. Don't do that, guys. But let's say you're bearish on it. I don't believe Microsoft's gonna pass $230 by the 31st. Okay, I'm bearish on them. Did I say bullish? I'm bearish. All right, I'm bearish, guys. So what does this mean? I want to capitalize on it. When you buy or sell a call, depending on what you're doing, you always lose money because of time decay. That's one thing that spreads capitalize on, because you don't have to worry about that. That's what you get your money for. So, okay, let's say you sell a call. In order to sell a call, you have to have the shares. So let's go right over here. Boom. I can't sell it. I don't have enough shares. What? I thought I did. So let's go around and let's go buy one. Okay? I want to buy some. But I'm already getting $88 for this. That's some, credit. So do I want to buy it at 140, sell it at 230? That's very risky. What are you going to do? You're going to buy it higher because it's cheaper. Yes, that's what you capitalize on, guys. The time that it takes for your share price to never reach that. You keep that money. So in order to do this, like I said, it gives the only way to get into a spread or get into selling a call without having the shares. That's a naked call. Without doing that, you buy a call. That's what makes you that's what makes you get into this trade, get into the spread. That's all you have to do, guys. So then you go continue. Boom. Let's say you want to do 15 of them, babies. Let's go, $600. But what are you risking with 15 of these? You're risking a lot. You're risking not much, baby. You're risking not much. That's a lot of money. So, Cruz, why are you telling me this? Why do you want me to lose all my money? I'm not saying you're going to lose it. You have to do your due diligence. You have to know what you're doing. Same thing with puts. You can do puts. You can do spreads. You can do anything. Anything you set your mind to, you can do. All right? Well, how do you do puts, you may ask? Same thing. This is if you're bearish on a stock. If you think it's not going to pass a certain price. The put, you can do a put credit spread. You can do a put debit spread. You can do a call debit spread. You can do a call credit spread. Whatever you want to do, depending on how you're feeling. If you're feeling bearish or bullish. Anyways, all right. So how do you do a put, you may ask yourself? And how does it work? Opposite. So instead of you being bearish, not feeling like it's gonna go to 30, and not feeling, do your due diligence. Don't feel anything. Do look it up. Do your research, guys. But anyways, let's say you wanna sell a put, right? I don't know if you guys knew, but when you sell a put, that means you're putting your money down, your cash money, baby. So let's say, for example, I want to go over here. I want to do this 220 strike price. Right? Okay, strike price is what you're agreeing to buy it at. Always, okay? That's always the strike price. Premium, this is how much you'd be getting or paying depending on what you're doing. You buy, you pay, you sell, you're getting, okay? Keep that in mind. Boom. Expiration date, all right? Always have that. Share price, strike price. Okay, anyways. The Greeks, delta, theta. I will get into that some other day. But how are you capitalizing a put spread, you may ask? Well, and what are you risking? Same scenario. Let's say you want to do the Microsoft. No, let's go something better. Okay, let's do TNA, my favorite ETF. Great stock to own in your portfolio. Okay, ticker symbol TNA. Okay. Anyways, let's say, for example, you want to get into some TNA, so your bread and butter, because I'm telling you, TNA, you cannot go wrong. Great. Anyways, boom. Let's say you want to do a put, right? We're selling a put. Okay, as you can see, that the strike price difference is 50 cents. 50 cents? That's $50 as collateral. Yes, baby. Yes. $50 as collateral. Okay, then 24. Oops. All right, let's go somewhere realistic. Okay, 31st. Okay, there, it gives me a little bit more time. You don't always want to do weeklies. You want to give yourself some time, because you never know how this crazy market is going to do. And don't always get too cocky, because you never know what this market's going to do. All right, anyways, boom. Let's say you want to sell a put, okay? You sell a put, you're putting $6,400, let's say $6,500 down. But since you're selling, you're getting, right? Okay? You're not buying. So you're selling this. Boom. let's say you want to do this. I want to do 2 of these, baby. Nah, let's just do 1. All right. Anyways, I'm getting $229, but they're taking that much money from me, and they're putting it aside until the 31st, baby. All right. What does this mean? All right. Well, they're taking my money down, right? And then I'm getting that much back. Okay. Well, I don't have enough money. Oh my gosh. I just started, I only have $200. Okay, $100. All right. Well, in order to get in this trade, and if you don't have that much capital, you can still get into it, but you're gonna minimize your potential gain, of course. And that's always the risk. But when you sell a put, it's always safer because you're at least getting shares for it. You're putting your money down, but you're getting shares and you're getting money. They're paying you to put your money down. That's no brainer, okay? If you do have the save, if you don't save it, guys, you can put your money to work. Put your money to work for you. Anyways, all right, boom, sell. You're selling a put. I don't have enough money. What am I gonna do? I'm gonna buy some. I'm gonna buy some, but I'm not gonna be buying it higher. What am I? Cruise? Yes, I am. So you're gonna be buying it cheaper. Okay, so like I said, same scenario. This put credit spread, you capitalize when it goes up, when the stock market goes up. Same scenario. Let's say you want to do 150 collateral, you get $14 return. What is this, like 20? This is like a 30-70 ratio. Not too bad, not too shabby, but it could be better. All right, but that's how it works, and that's really all. That's really all there is to it. Now, what are the risks? Of course. Well, you're risking your money, and you're not getting anything in return if it goes sideways. You're getting the credit for sure. Always keep that in mind. You're getting the credit, but the collateral really does go away if it does go sideways. You can always get out of it. You can always buy yourself out of it, but it sometimes tends to be more expensive than just letting it play out. If you let it expire worthless up until the expiration date, then usually Robinhood will execute the trade for you. But that is the risk. You are risking that amount basically, because that money is in there. If it drops below 64.50, you lose the whole amount. What does that mean? Well, $50 is gone, but you're at least getting 14. That's what it means. Yes, that's what it means. But like I said, there's a lot of things that you can do with it. You don't have to do spreads, guys. You don't have to do spreads. The safest thing to do is sell a put. Yes, sell a put. Put your money down, let them take your money. You have a couple grand saved. Come on, put it to work. What are we doing, guys? Come on, we're only getting older. Time's only going by quick as. Anyways, okay, I have $6 right in my bed stand, right? Okay, I'm gonna get $200 just putting it in the market, just for them to take it from me, put it aside, and on the 31st, if TNA doesn't drop below $64, I'm getting $200 for free for doing nothing. And let's say for example, it does go down. All right, what if it goes down? Well, you capitalize on the other way. And what is the other way, you may ask? Okay, boom, you got $200. They took your 66 grand, 6,400, because TNA dropped to 55. No, 60, because it's not gonna drop to 55. Not anytime. Anyways, they say 60. That's a more realistic number. All right, 60. Boom. What does that mean? Well, you got shares. You're down $4 from them. So 4 times 100, you're down $400 because now it's only $60. But you bought it at 64. But you're not averaging in how much you actually got from the trade. You got $200, so you're technically down only 200. All right, what do you do then? Well, guys, come on. You go and you have the shares. When you have shares, you can sell calls. Covered calls. Duh, come on. Covered calls. Because like I said, in the spread, you can't sell calls if you don't have the shares. But baby, you just bought them at a overpaid price because now it's at 60. But okay, I bought it at 60. I bought it at 64, right? 64, and now it's at 60. Boom. Well, I'm not gonna be wanting to sell it at 63. What am I? Me? No, 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 no. You're gonna be wanting to sell it higher, of course. I mean, you don't have to do it 64. You know, you can do it. You can do it $1 higher if you want to get rid of it quick. You can do it a couple. You don't have to. You don't. If you don't. If you want to keep the shares, if you really feel good about the purchase you just make it unrealistic. Make the price that you choose unrealistic. And what does that mean? Boom. Look at these prices. Come on. $20. It is possible though. Don't get me wrong. TNA, like I said, it's something you want to have in your portfolio. Great option. But okay, it is possible. But even if it was possible, and even if it did happen, you'd be capitalizing even more. If you do want to keep the shares, don't sell it. Of course, you can always buy yourself out of it. Okay, always. Usually, if you have the money. Okay, but anyways, boom. What does this mean? Well, if on the 31st, let's say I sell this one right over here. If on the 31st TNA is above 71, I'm selling it at 71 for that guy, even though if it's at $80, $90, whatever, I still have to sell it at 71. And I'm still getting the $171 for selling this call. Okay? On the 31st, of course, on the 31st. So I have until that date. But that means I'm going to be missing out on the potential gain from 71 up to 85 or 90, however much it goes. Let's say crazy skyrockets. I'm going to be missing out on that. But I am going to be getting the difference. Because keep in mind, I bought it at 64. Okay? Sold that put. Bought it at 64 or 65. I forgot. Now I'm selling it at 71. What? Come on, guys. It's a cycle. You just got to do this over and over again. Put your money to work. Put it to work. Anyways, guys, yes, that is it for today. Just a little breakdown of what I've been doing here recently. It is a lot easier to capitalize on spreads, but you do have to have it enabled. Like I said, you have to have that level 3 account. And in Robinhood, it's a lot easier to get that level 3 account than it is in other brokerages. But, just throwing that out there. Of course, it is risky. You are not getting anything in return if you do spreads. You are just putting your money out there. You're getting the collateral. But you can capitalize on it, baby. And just don't forget, always secure the gains. Because look at this. I'm done. No. Don't want to do this, guys. You don't want to do this. Like I said, I am still learning. I'm no pro. I'm just getting started. But next year is gonna be a year. We're all gonna grind together. All right. But you might be thinking, Cruz, come on, how are you gonna do money? A lot of money in spreads. Well, guys, come on. I got y'all. Let me show you an example real quick. Okay, TNA, same company I was talking to you about. All right, I did some a couple weeks ago, maybe 2, maybe 3. But let me show you guys. Boom, spread right here. The December 10th. Okay, boom, right here. I did 20. All right. What does this mean? Well, the difference that I got was 1,200. Well, you got to divide that times how many I did. 20. So I don't know how much that is, but maybe like 20. I don't know how much. However much that was, like $60 maybe, 50 something. Okay. Anyways, boom. All right, times 20, because that's how many I did. Well, the strike price difference is 62 and 65. That's $3. $3 times 20. What is that, like 60? 60 times 100. That's $6,000. That's how much I was putting in that trade. That's how much money I had in the air for them to just take. Yes, it's very risky, but like I said, you can capitalize if you know and you do your due diligence. Yes, you have to grind. You have to search. You have to spend hours. You have to put some work in, because you can take it as a hobby. You can take it however you want. If you're just an investor, okay, an investor's fine. But if you're doing options, you have to put in the work. You have to grind. Guys, it's 1:55 in the morning. I'm trying to do a video because I suck at making videos. And I'm posting this, and I'm not going to be editing it because I don't want to edit. And it's late, and I'm sleeping. I got to work tomorrow. Wake up in the early morning market. Yes. But anyways, capitalize on it. The gains, baby. All right. Well, anyways, 1,200, right? The next day is the day it expired. I don't know if you guys saw. It expired on the 11th. I did it that one day. 12. What? Now, like I said, very risky, but you can capitalize from it. When you do spreads, it is not affected by time decay. If anything, that's all it needs. If it breaks, if it doesn't get in between your strike prices or below it, depending on what you're doing, then you're gonna be getting just that free money. The difference of the contracts for free. If you want to be safer, you don't want to risk too much, just do puts. Just sell puts. Come on, guys. Just do this over and over again. You sell a put. Let's say you do this 5 times, you get $500. Okay, you don't have to buy any shares, but then with that one time you have to buy it, go and sell the call. Go and sell a call, a couple dollars up. If you want to keep the stock, make it unrealistic, but capitalize. Always capitalize. But yeah, that's pretty much it for you guys today. I don't have anything else. It is pretty late. I am tired. I want to go to sleep because I want to open up. I want to wake up early for the open market. Yes, and I have to work at 9. So got to be up like around 6:30, maybe 7, maybe 7, maybe 7:30. I don't know. I'm tired. But hopefully we can capitalize, and I have to get out of these trades early tomorrow because it's not going to be pretty. But that's it for you guys today. Thank you guys for tuning in. I hope you guys have a good night, and goodbye.